All right, so you're curious how to invest your 401k, but not sure how aggressive your allocation should be. It's no problem. Spoiler alert though, it's not as hard as you think. You just need to be equipped with the right knowledge and terminology, and you'll be on your way. What's up, guys? I'm Kay Scholl. Welcome to another financial awareness video. Over my 8-year time span as an advisor, this question came up all the time. We'll go over a few things you need to consider so you make an educated decision. Let's get to work. So here's the deal. There is an easy way of doing this and one that requires a little more effort. The easy way is simply to pick the year you plan on retiring, then go to your 401k and rebalance all of your holdings and your future contributions to what's called a target date fund for that year. If you're 30 years old right now, that might look something like a 2055 target date fund. Boom, done. Think of target date funds as if you're already flying the airplane and you hit autopilot. This won't help you with your landing, but it will help you get from point A to point B. When I say landing, what I mean is the distribution phase of your financial plan, because right now you're probably still accumulating your assets. If target date funds are all you're looking for, feel welcome to click out of this video and go check out this one right here about different types of retirement accounts. I'll give you a second to think about it. That's a good one. Right there. Okay, cool. So if you're still watching and want to learn more about asset allocation for your risk tolerance, time horizon, and age, then the first thing you should be aware of is seeing the forest through the trees. What I mean is, any of your friends or work colleagues could pick apart your 401k positions and maybe point out some potential flaws, but you, the investor, need to be financially aware of how the allocation of this account fits into the overall picture of your financial plan. This can be further explained in an entirely different video about modern portfolio theory. Hit that subscribe button and stay tuned for that one. As an example, among other assets, my wife and I have like 6 or 7 different retirement accounts, and this is just one of them. As you can see, we only have 0.5% invested in bonds and 99.5% invested in stocks and equities. According to the Vanguard algorithm, without knowing anything about my wife and I, they are suggesting we have 10% of our holdings of just this one account in bonds or fixed income securities. Hey, quick question. What type of investor are you? Let me know in the comments down below what type of investor you are. Aggressive, conservative, stocks, real estate. I'm curious so I can plan out future videos that align with your goals. Although that information from Vanguard is helpful, if you don't have a financial plan, then this could result in you making an uneducated decision. Not necessarily a good or bad decision, just an uneducated one. Now, in all reality, we have about 7.5% of our total assets held in fixed income, so that Vanguard example wasn't too far off. But just like I've said in other videos, you need to give your retirement dollars a job to do and let them do their job. Inside this account, for us, these dollars are not supposed to be invested in bonds. And the 0.5% that's there is simply a result of one of the funds we own having a very small portion of their holdings in bonds. Remember, now that you can see the forest, let's start walking through the trees. Okay. With that out of the way, the first thought when considering how aggressive you should be is time. In the investment world, this is what's known as your time horizon. For any account, your 401k in this example, your time horizon is the amount of time you plan on keeping your money invested before you anticipate making any withdrawals. Keep in mind, though, that once you arrive at your destination of retirement, you probably won't withdraw all of your money all at once, and you'll probably only pull out a little bit based on your retirement needs and goals. This is what's known as the 4% rule. So you probably won't withdraw everything in one lump sum, and you should take that into consideration when thinking through your time horizon. If you have a long time horizon, then you can financially and emotionally afford to take on more risk at the beginning of establishing your investment. Because if something negative does happen in the short term, pandemic, then you can navigate through it or hold your positions before actually pulling out any of your money. If you have a short time horizon, then just be financially aware of the risks that can pop up unexpectedly without having the time to recover from such losses. After considering how much time you have, the next thing to consider is how much you can save based on your personal budget. To overcome many people's initial anxiety to start investing, I started sharing a term that popped into my mind one day called budget-based investing. All this simply means is that no matter how much money you make, you save or invest some based on your budget. Trust me, if there's anything we've all taught ourselves over the past few months of 2020, it's that with enough sacrifice, you can adjust your lifestyle and spending habits if need be. Also, while on the subject of how much you could afford to save, you should decide which of your investment buckets you want to fill up. You may not want to save as much to cash if you already have an emergency fund. If you don't have a fully funded 3 to 6 month emergency fund, you may want to save more to cash. This actually will protect your investments and allow you to take more risk. Because if something bad happens to you while the market is down, this will prevent you from liquidating those investments just because you need some extra cash. So now you know your time horizon and how much you could afford to save. The next thing to do is understanding the different allocations and what they mean. Let's check out some pie charts. Okay, so each of these pie charts represents an asset allocation for either an individual account or how you overall as an investor consider yourself. Without knowing the specifics of any one person's individual account or financial plan, I'll go over the different investing styles to shed a little more context on each one. Okay, so conservative and moderately conservative asset allocations, as you can see, they are predominantly held in fixed income securities with 80% and 60% respectively. I would say folks that fall into these categories are either emotionally scarred from a previous investment experience and too timid to take on more risk, or maybe they're already in retirement and they don't want to damage the golden goose that lays the golden egg, so to speak, to where they care a lot more about preservation of principal, liquidity, and generating an income off of this particular asset allocation. Okay, next up is the balanced asset allocation. And as you can see, we are trending down from 80, 60 to now 40% held in fixed income. I would say a balanced investor is a little bit on the fence. They want to take a little more risk than a moderately conservative investor, but don't want to jump neck deep into the more aggressive asset allocation. They want steady and sustained growth and less volatility. From a volatility perspective, if you will just imagine the tip-top peak of the Rocky Mountains and the very bottom lowest point of the Grand Canyon, that measurement from peak to trough is called volatility. And a balanced investor does not want to experience the high highs and does not want to experience the low lows. So when the stock market is going really, really well, more aggressive people are happy and balanced people are okay. But when the market goes down, the more aggressive allocations are feeling every inch of that drop, and the balanced investors aren't feeling as low lows. So they're more comfortable with that slow rolling mountainside type of asset allocation and investment return. Aggressive allocations and very aggressive allocations and investors actually have a lot in common. Both are looking for long-term growth. One has, as you can see, 20% of its allocation invested in fixed income, and one has hardly any with only 2%, that being very aggressive. Although they both want long-term growth, these allocations have different types of risk structures that they're willing to take to get there. An aggressive allocation is willing to take reasonable risk to accomplish that growth, and a very aggressive investor is willing to take substantial risk. If you've got two buddies and one is an aggressive investor and one is a very aggressive investor, I would say these are the types of people that will argue over who has more alpha in their portfolio. If you want to learn more about which type of investor you might be, I'll leave a link in the description down below to the Vanguard Asset Allocation Tool. There is usually an evolution in your personal financial journey. Everybody starts out as a beginner and novice. Over time, as you save money, live your life, and build your wealth, your knowledge will grow. Whether you're saving cash, paying off debt, investing, starting a business, or buying real estate, my hope through this channel is to encourage you on your journey wherever you are, and for you to become more financially aware of your personal financial decisions. Hence the name Financial Awareness with Kay Scholl. As your financial awareness and knowledge grow, you'll become more equipped to make better decisions that fit within the overall picture of your financial plan. Hey, thanks for watching. Appreciate your time. If you have any questions for me, leave them in the comments down below. Thanks.